because inflation is going to be much higher, and that's why the gold price is rising the way it is, and that's why bonds are falling, because inflation is bearish for bonds and bullish for gold. And so they're doing exactly what you would expect that they would do. The mainstream investors don't really understand what's going on. That's why they're not buying gold and silver. That's why gold and silver, even though they're rising steadily, they're not like soaring, right? Because there is no panic to buy. It's a very orderly, methodical rise that's happening day after day after day with minimal corrections.
Gold is capturing significant attention in the financial markets, surging past the $2,700 per ounce mark and reaching an all-time high of $2,707. Economist and gold advocate Peter Schiff views this as just the initial phase of what he predicts could evolve into a monumental bull market for gold. Gold is not only reaching another record high tonight, but it is also trading above $2,700 for the first time, he states on the social platform X. Following this, he notes that gold has surpassed $2,720, further reinforcing his bullish outlook. As the chairman of SchiffGold, Schiff has consistently expressed optimism about gold's potential, suggesting that its journey from $20 to $2,600 per ounce could ultimately lead to prices reaching $26,000 or even $100,000. The consistent rise in gold prices signals growing concerns about inflation and a deteriorating fiscal situation, characterized by increasing budget deficits leading to an oversupply of U.S. Treasury bonds. This upward trend in gold differs markedly from past price spikes, often fueled by panic. Instead, it reflects a more deliberate and strategic metal accumulation. Investors appear to be recognizing gold's value as a safe haven amid economic uncertainty rather than engaging in speculative buying. While gold and silver have eclipsed their pre-pandemic highs from 2020, mining stocks have yet to experience a similar surge. This lag in the mining sector suggests a significant breakout may be on the horizon, particularly as economic indicators point to deteriorating conditions that could prompt a stronger reaction from investors in precious metals. Moreover, as Peter Schiff highlights, Brics nations actively seek economic independence from the US dollar, positioning gold as a crucial component in this shift. Collectively, Brics countries control over 20% of the world's gold reserves, with Russia holding 8.1%. As discussions about a potential new Brics currency gain momentum, gold-backed initiatives may become essential for enhancing the economic autonomy of the United States, positioning gold as a key player in future financial strategies. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
So we still have a weak economy. That's not why rates are rising. Rates are rising for the same reason the gold price is rising. It's because the Fed's rate cuts are a mistake. The inflation genie is not back in the bottle. We're going to have rising inflation. We're going to have skyrocketing fiscal deficits. So bigger budget deficits. We're going to have more supply of treasuries hitting the market, which, as I've said, are going to be monetized. I said the reason that the Fed is going to go back to quantitative easing, and I've said this since before they cut rates, when I predicted that the rate cuts would result in rising bond yields, I also said that eventually the Fed would end up going back to QE to try to get those bond yields to go down, because I knew that the rate cuts alone wouldn't be enough because they were inflationary and they were bearish for bonds. So if the Fed really wants bonds to go down, it's going to have to buy the bonds itself. But of course, first it has to stop selling bonds, because that's what it's doing now. It's selling bonds, and a lot of other people are selling long-term bonds. You'd have to have your head examined to want to buy a long-term U.S. Treasury, even at 4.2%. Inflation is going to be well in excess of that. That's what the gold market is saying loud and clear, except nobody is paying attention, at least, in the mainstream, because inflation is going to be much higher. And that's why the gold price is rising the way it is. And that's why bonds are falling. because inflation is bearish for bonds and bullish for gold. And so they're doing exactly what you would expect that they would do if you understood the predicament that the U.S. economy is in, and if you understand basic economics and finance, which of course nobody does if you're in the mainstream financial media, and most of the mainstream investors don't really understand what's going on. That's why they're not buying gold and silver. That's why gold and silver, even though they're rising steadily, they're not like soaring, right? Because there is no panic to buy. It's a very orderly, methodical rise that's happening day after day after day with minimal corrections. And you're not seeing any, blowout move in the mining stocks. Yes, finally, we have new 52-week highs, multi-year highs in the GDX and the GDXJ. The next key resistance is to really take out the 2020 COVID high. Even though gold itself and now silver, both metals are higher than they were in early 2020. Neither of the gold stock indexes, or there's more than two, but none of the gold stock indexes have taken out their highs yet from early 2020. That's coming up. That may happen this week. And then I think it's off to the races. The idea that bonds are rising because the economy is strong, no. And in fact, I heard more people again say that, well, the strong economy means more inflation. And so that's also pushing up bonds. No, a strong economy would normally mean lower inflation because the strong economy would produce more, which would keep a lid on prices. It's weak economies that result in more inflation because they result in more stimulus. They result in more money printing. Government revenues go down, their expenditures go up, they have bigger deficits, they print more money. So weak economies are historically far more inflationary than strong economies. That's what's going on. It's not about a strong economy. It's about strong inflation and a huge supply of bonds for which there are few buyers. And I'm going to get to more of that after this break. We're going to talk about the Brics summit, which is another reason I think that the dollar is going to come under a lot of pressure and why bonds are already under pressure. So
the ongoing Brics summit in Russia marks a significant shift in global dynamics as leaders from China, India, South Africa, Brazil, Egypt, the UAE, and Iran gather despite widespread sanctions against Russia. This meeting highlights a shared goal of reducing reliance on the US dollar, with discussions centered around creating a trading system that eliminates dollar transactions. The idea of Russia leading an anti-dollar initiative is particularly concerning for the US, which has long relied on the dollar's dominance to maintain its global influence. With Russia, China, and Iran all navigating conflicts with the West and India facing its own tensions with Canada and the US, Brics is positioning itself as a formidable alternative to Western dominance. During the summit, Russia is expected to advocate for an alternative international payment platform that can withstand Western sanctions. Reports suggest that Putin may propose measures aimed at de-dollarization, which could significantly alter the global financial landscape. A key aspect of this initiative involves establishing a payment system that connects commercial banks through Brics central banks, allowing member countries to trade without using the dollar. The Russian economy's stability and the ruble's resilience challenge expectations of chaos due to sanctions, prompting other nations to consider how to protect themselves from similar pressures. By investing in gold, which is difficult to sanction, these countries aim to shield their economies from U.S. financial influence, reflecting a notable shift in the international economic order.
Getting back to this Brics summit, so it's being held in Russia, right? Which is supposedly, right, oh, we've got sanctions against Russia. The whole world is supposed to be, staying away from Russia, blackballing Russia. They're the bad guy. Putin's the bad guy, right? Leave him alone. Yet you have all these leaders from other countries, from China, from India, South Africa, Brazil, Egypt, United Arab Emirates, Iran. All these leaders are now, in Putin's, backyard. They've come to Putin, right? So they're obviously not boycotting him. They're all there. What is the primary goal these nations have? It's to distance themselves from the United States dollar. That is the main agenda. They want to trade with one another without using dollars. So when China buys something from India, they don't want to pay for it with US dollars. They don't want to use the US dollar in these transactions. And they don't want to hold US dollars as a reserve for their currency. So they want to come up with another system that basically eliminates the need for dollars. This is a big, big deal because now more than ever before, we need China, India, Russia, all these countries to buy dollars, to buy our bonds, because we have bigger deficits than we've ever had. We have to sell more bonds every day, every week, every month than we've ever sold before. And we need buyers. But the buyers are saying, we don't want to buy. We're trying to figure out how to run our lives without your dollars, right? Without your treasury. So we're moving away. They're going to create their own system. I don't know how they're working. I have a pretty good feeling that gold is going to be a part of whatever they do. If they come up with a new basket or a new trade currency that they could use to settle all their deals, it may include gold and some other basket of their currencies, right? Their own currencies. The dollar won't be part of it. The euro won't be a part of it, right? They're going to have their own trading block. And if you think about these countries, first of all, the population that you're talking about, I mean, when you get India and China together, I mean, that's a huge population. Those are the two largest countries by far in the world. But then, you throw these other ones in there and think about the resources. It's not just the energy that you have in Russia, in the United Arab Emirate, in Iran, but the minerals that you have in China, in South Africa, in Brazil. So these are resource intensified economies. And so this is a huge potential threat to the US dollar and its place in the world. And we're ignoring that. And also part of the impetus to move away from the dollar are the sanctions against Russia. And it's not an accident that the Brics summit is being held in Russia. I mean, they could have held it in any one of these countries, but they held it in Russia. That is basically a thumb in the eye of the United States because they're saying, hey, we don't care about your sanctions. You know what you can do with your sanctions? We're going to Russia. And by the way, the Russian economy is doing fine. The ruble is doing fine with all these sanctions. We didn't impose the economic chaos that we thought when the sanctions were first put on into Russia. But what we did is we galvanized all these other countries that don't want to be the next Russia when it comes to sanctions. So if they move to gold, which is why they're buying all this gold, we can't sanction their gold. If they own gold and store it within their own borders, we can't do anything about that. Yeah, if they hold U.S. Treasuries, sure, we got them by the balls. That's why they don't want U.S. Treasuries. But the problem is, who's going to buy them? Because we have to sell so many of them. I was listening.
The BRICS nations increasingly focus on gold to reduce their reliance on the U.S. dollar, highlighting a significant shift in global economic strategies. This collective interest in gold signals their intent to enhance economic independence and find alternatives to dollar-dominated transactions. By prioritizing gold, these countries aim to secure financial stability and strengthen their positions in international trade. As discussions around alternative payment systems evolve, gold will likely become a crucial asset in this new framework, potentially driving higher prices due to increased demand. Please share your thoughts on Peter's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.